Good afternoon, everybody, and welcome to Scope's webinar on our macro and credit outlook for 2023. The theme being new conditions for a new year are inflation, recession, and default risk fading. My name is Dierk Brandenburg. I'm Scope's head of ESG and credit research, and I'm joined today here by Dennis Shen, a director in our sovereign ratings group and the architect of our biannual sovereign outlook. And I'm joined by Sebastian Zank, the director in our corporate ratings group, who will talk about what those outlooks mean for corporate credit quality this year. As always, you can find the download material on the bottom right of your screen under the apps button. Here you find the latest version of our sovereign outlook, and you can also find slide decks for today's presentation. And as always, we will also provide a recording after this session. To kick matters off, I will briefly introduce the subject and then hand it over to my colleagues. What is remarkable, I think, about the start of this year is that the sentiment going out of last year was particularly poor, both with regard to growth, but also the pressure from inflation, clearly also not helped by some pretty hawkish central bank commentary, particularly from the ECB just before Christmas. But since the beginning of the year, we've seen quite a change in sentiment. Certainly when we look at business confidence indicators, or also this morning at the PMIs that came out. And we can also observe that relative to those very poor expectations that we had coming into 2023, the actual data has actually surprised to the upside, particularly in the euro area, but also, and this is increasingly important, in China with the reopening after COVID. This very much chimes with the theme of our sovereign outlook that we published back in December, where we took a rather above consensus, more constructive view, particularly on European growth in 2023. Background here is clearly receding inflation, certainly headline inflations, but as we argue, and Dennis will explain this later on, core inflation could still remain very sticky this year. But nevertheless, at this point at least, there seems to be a peak in sight for the rate hiking cycle. Unfortunately, that is combined with a cycle that has yet to run its way, which is the reduction in central bank balance sheets. As you can see, that started really in earnest in the last quarter of 2022. And it may indeed look impressive to see that central banks took about 2 trillion of balance sheet stimulus out of the economy, mainly in Europe, which was the cancellation of the TLTRO initial tranches, and then certainly in the US. But bear in mind, we have just moved from a 30 trillion balance sheet to a 28 trillion balance sheet here. So this story has a lot to run. And clearly this is one of the concerns here, particularly also for credit markets, to what extent that will weigh on financial conditions, even beyond the actual rate hike cycle here. One area, particular for corporates, which is important, is that in general, and quite to the surprise, I guess, to many already back during the COVID crisis, and again now, is that the banking system is actually functioning pretty well given the circumstances, which has certainly helped because we basically did not see a credit crunch, neither in 2020 nor in 2022. But what we can see is, in response to slowing growth, that banks have tightened their credit standards, both for large and for small corporates in the euro area. And we can also see, as a result, companies at least intend to borrow less going forward. So that shows you that some of the sort of more tighter conditions are actually feeding through into the economy. And then another important point, companies have been drawing down credit lines pretty aggressively during 2022. A couple of specific points here, particularly around margin calls for energy companies, but in general, a sign that companies did need extra liquidity in 2022, which either banks will have to finance out or term out into the bond market, or corporates will have to repay. I think a lot of Sebastian's presentation will focus on the position of corporates in this matter. We at Scope, we track financial conditions with our own in-house index, where we essentially look at financial market variables. So these are market prices, and we look at them relative to their historical averages. And you can see that 2022 certainly was a pretty dramatic year for financial markets, with both interest rates rising pretty strongly, which is the blue line at the bottom, credit spreads widening, equity markets selling off, and commodity prices rising. So a pretty toxic cocktail, particularly for corporates. But at the same time, what we also can see that a lot of those trends actually peaked already back in October, and financial conditions certainly since the beginning of the year have improved quite a bit, which has actually opened up quite a substantial funding window here for companies and banks and other borrowers in the first quarter. However, as you can see on the right-hand side, if you look at the amount of distressed corporate bonds that are still out there despite this rally, you can see that this is quite a significant amount, certainly by historical standards, recent historical standards. And this bears indeed the question, even with improving sentiment, there seems to be a sort of bottom group of companies that either are trading at distress levels and may not be able to refinance, or indeed eventually default. Analyzing this data set a bit more detail, it allows you to pretty much pinpoint down where the problems are at the moment. By country, you're not surprised to see the UK, Germany, and France here as the largest euro area of European economies. And then obviously Luxembourg, many cross-European players located there. What's interesting about the country breakup here of distressed debt is that the countries that are not featuring on there very high is Italy and Spain, despite the size of their economy. And then other countries such as Sweden appearing on the list, despite being a comparatively small part of the European credit universe. And that can be explained by, I think, the sectoral breakdown of distressed debt that we have in the system at the moment, clearly led by consumers related industries, both discretionary and staples, essentially a reflection of the earnings squeeze and the cost of living crisis caused by inflation, as well as sort of inventory overhangs after the COVID rebound. And then another big area is the most interest rate sensitive credit universe, which is the real estate companies. So again, we will shed further light on this later on in this presentation. So with this in our background, I want to hand it over to Dennis. And Dennis, can you please give us a brief overview about having this positive sentiment in mind, what this actually means for our outlook for 2023?
Thank you, Dierk. So hi, and as reference, I'll talk through the 2023 global economic outlook that we published in December of last year. I think first of all that from a multi-year standpoint, per the title of the slide, we take the view for there to be a new normal of more volatile economic growth globally and also in Europe. More significant downturns, but also more significant upturns in that respect. In the outlook, we revised down on a calendar year basis our 2023 global growth number to 2.6%. That's in the orange line in this graphic. But I think, as Dierk has been referencing, that the thematic for the year is one for slowdown, yes, but not for recession or for severe recession at a global level or at a euro area aggregate level. And that's noted in this diagram, which has been a consistent thesis of our group. In this diagram for 2023, in terms of the major regional blocks in the different color shadings, weak economic growth, but not bars that are pointing in a negative direction. And also importantly, per this one bullet point that we include towards the top right, is that we introduced, as by and large one of the only institutions to, for the so-called skew of risk to the global economic outlook, whether the risks to the baseline are tilted to the downside, to the upside, or roughly it's a mixed bag. There's a little bit of both. By and large, institutions, multilateral financial institutions and the like, it was conventional wisdom almost to have a negative skew to risk entering 2023. And we said no to that and took a neutral skew, that there are downside risks, yes, but there are also upside risks. And one of those on the upside, as has been talked about, certainly and crystallized already to an extent, is the reopening of China after the anointment and decision of the People's Congress in China for a third term for President Xi. Within this environment, naturally, one of the wild cards is inflation, as noted. We relatively early on in the summer of 2021, when generally the consensus was that inflation will be temporary, inflation is transitory. After it first started to trickle up at that point, we came out with a non-consensus thesis at the time, which is that inflation is likely to be higher for longer, that there's a degree of permanency to some of the inflationary dynamics. It is not simply only about temporary COVID-19 supply side bottlenecks and a supply side demand side mismatch. And in that respect, even though inflation has peaked in many constituencies and is gradually declining on the left-hand graphic, partly led by the United States and the green line, the United States being helped by the strength of the dollar, at least for a large part of last year, although, of course, a lot of that has reversed more recently. But nonetheless, on the right-hand side, because inflation has been out of the bag for as long as it has been, a lot of the inflationary dynamics are, to an extent, self-sustaining. That's displayed in terms of the high level of core inflation now. So even though headline and core are likely to go down progressively over the course of the year, because of how much it already has increased, wage negotiations, inflation expectations, and the like, it simply will not be completely straightforward for central banks to reduce inflation at least to the 2% objective, to all the way down to 2%. That's going to require more vigilance and require certainly patience. So within this environment, from a rating standpoint, yes, we have a neutral skew from an economic risk standpoint, acknowledging a degree of possibility, if not expectation, for a degree of recovery over the course of the year. But from a rating standpoint, under conditions of high inflation, still rising interest rates, at least in terms of policy rates, even though yield levels have declined rather significantly in past weeks, but still rising policy rates on the short end of the curve, and so on, we announced a negative aggregate skew for sovereign risk. And that is illustrated on the right-hand side of this graphic, with there being, of our rating portfolio, more countries at the sovereign level currently being rated on negative outlook within this environment than on positive outlook on the bottom green bars of this graphic. This slide just demonstrates some of the rating differentiations of the sovereign group for a select sample of the 38 countries that we rate publicly in terms of the ratings differentiation compared to the average of the three United States credit rating agencies. And certainly in this environment, we have not been shy about downgrading. On the right-hand side, comparing us since the full-scale invasion of Ukraine, in terms of the rating actions that we've taken compared to some of the peer rating agencies. Certainly in terms of the downside rating actions, a lot of that has been in emerging markets, where the risks have been particularly acute, and especially the two warring parties being the Russian Federation and the Ukraine. In the advanced world, including in the euro area, the ratings migration over the past year has been more benign, admittedly. And many of the positive rating actions that we've taken over the course of this past year have been in the euro area, including for the euro area periphery.
Yeah, thank you, Dennis. Maybe just coming back to the growth outlook, which I think is probably the most interesting point here, especially given where sentiment had moved. I think one of the reasons people were particularly negative about growth in Europe, in particular in Germany and I guess Italy, was around the sort of really nasty downside scenarios with regard both to the cost and then also the availability of energy, natural gas in particular. Now it seems to be a lot of the optimism is based on just that really bad downside scenario not materializing, both in the fourth quarter of 2022, but then also increasing optimism that this will not come out in the first quarter of this year. Dennis, I mean, what else is there to say about European or Euro area growth this year? I mean, we still have a consumer that is really stretched from high inflation, falling real wages. I mean, is there any other optimism other than just having said we have avoided the worst case scenario?
Yeah, I mean, I think to that question, I wouldn't necessarily use the word optimism. The fact is that in terms of the baseline forecast that we have for the euro area, the projection is still for significant slowdown. And for the aggregate, for the euro area as an aggregate, for growth of 0.7% this year. I suppose compared to market forecasts over the passage of 2022, when many in the markets were expecting recession and still are, in many cases, expecting recession in the euro area this year, compared to that as a benchmark, on a comparative basis, I suppose the illustration that we want to make is that there is a greater degree of resilience. I mean, there were market expectations that because of the economic weakening, that the ECB might be forced by this point to cut rates. Obviously, that's not happening in terms of the degree of weakness in the economy to propel that. And nearly half of forecasters at some stages in 2022 were concluding that there would be a debt crisis or a financial crisis within the euro area because of the rising rates. Because if the anti-fragmentation instrument that ECB introduced, if it didn't really pan out in terms of the efficacy, and so on. So maybe some of the worst case or the adverse scenarios might have been sidestepped, at least to this point. Certainly the mild weather so far on the whole for the winter in Europe. Certainly that helps. The degree to which the storage of gas of the natural gas has been still above 80% in terms of levels of for many countries, still at rather decent levels. Certainly that supports. And within this environment, entering through 2023, with inflation already having begun and expected to continue to gradually show some level of decline, supporting household consumer purchasing power in lockstep. And then also, of course, with the degree of fiscal support, price ceilings for energy prices and things of that nature, fiscal support. The fact, the degree of resilience in 2022 in the euro area, the fact that what people did not expect is that there was this pool of excess savings after the COVID-19 crisis, forced savings that came out in bunches in 2022, which supported the outlook even after the Russian full-scale invasion, even after that environment after February the 24th. That is still there to a lesser extent, but still there as a supporting element for the consumer in terms of the use of those excess savings in 2023, and also the aspects like the Recovery and Resilience Facility of the EU. There's even talk now as a response to the Inflation Reduction Act of the United States for the EU to consider any further joint bond issuance in terms of being able to present a rival as far from the climate activism side and the continent's longer term economic competitiveness. So that's all there as supporting elements. As you can see in this graphic, the growth numbers as a baseline are still rather poor, but nonetheless, in terms of that 0.7 that we have penciled in for some time now at this point, we are seeing a degree of migration in that direction more recently in terms of outlooks from other analyst institutions. And naturally, there have been some further signs of in terms of the high frequency indicators. Some of that has also been displaying some degree of turnaround. I'll stop there.
That's great. So let's, before we move over to Sebastian and to tell us what this actually all means for corporate credit quality this year, just to do a brief stock take here with the audience. We have two questions here that we want to bring up, and they're pretty straightforward. Based on what Dennis has just presented here. First question is very simple. Is there going to be a recession this year in Europe or not? Main point here being a calendar year recession, which means a negative growth number for the entirety of 2023. So you have three options here. You can basically agree with this, or you can obviously contradict this and argue headwinds are just too big and there is going to be a recession. So please vote now. And then once we have the results up on that one, Sebastian will already know what his audience expects. Wait a second. Right, there seems to be a delay there. Arvin, you want to put up the second question or the results first? Okay, we're going straight to the second questions. Apologies. So the other key question here, and again, very important also for the development of financial conditions, i.e. interest rates, will the inflation go back to the ECB's 2% target? You can answer between 2023 and 2025. We don't have the option never on here, but those people who believe that, they can probably tick beyond 2025. And again, we'll collect the votes here. And then I'm told actually we can see the results on the right-hand side of the screen. Apologies for the confusion here. Okay, well, let's move on. Sebastian, so overall, corporates were quite in the on the line in 2022, faced with this rather toxic mixture of very high inflation, high input costs, high energy cost, disruption from supply chains, and yet, as we know today, or as we expect today, a lot of particular large corporates probably going to have reported one of the best years ever. And yet we see a lot of distressed debt out there in the market. So can you just give us a brief rundown in terms of what your views are on corporate credit quality for the next year, for this year?
Yeah, thanks, Dirk. So the buzzwords that have been mentioned, primarily the sobering macroeconomic growth prospects, and also the topic of inflation, are certainly those topics that, are deemed as very important by the corporates ratings franchise for the credit outlook in 2023. I would add another buzzword, which primarily affects then a lot of companies that we have in our coverage, and that is refinancing risk associated with the changed interest rate environment. So that will clearly play a role. In addition to, for all those corporates, the sector-specific peculiarities, which might be positive for some sectors, but which are broadly negative for most of the sectors. So when you look at our ratings migration over the past 2 years, I've pictured the rating actions that we had over the last 8 quarters in the chart on the left-hand side. And there you can clearly see that there has definitely been a fundamental impact on rating actions that we conducted over the past few quarters. So particularly the amplitude of negative rating actions has picked up primarily since the third quarter of 2022, as we have seen that the topic of inflation, which for many companies squeezes margins, has become a real issue. When you see that out of our coverage that comprises roughly 320 corporate family ratings, more than 20% of those names have been affected by a negative credit rating action. That already tells you a lot of the story. That primarily relates to issuers that we classify as high yield issuers. So in the right-hand side chart, I've stripped out the rating actions for these speculative credits, where you see that the number of negative rating actions has by far outpaced the number of positive rating actions. So particularly in the high yield area, we are very wary whether the mix of economic growth, inflation, and refinancing risk will lead to a significant deterioration in credit quality for those names. On the investment grade side, we are rather relaxed because most of those companies, they can simply digest the overall environment from our perspective. Nevertheless, I don't want to paint an overly bleak picture here, because when you look at some more granular data, then you can strongly see that when it comes to sectors, there is a very uneven picture within our ratings franchise. We always have to be wary that our ratings coverage is, of course, to some extent pretty much geared towards very good credits that are listed in the iBoxx index, so investment grade companies, but it's also geared strongly towards high yield credits, with a rating around B+, BB-. When you split this up into the different sectors, then you can clearly see that the negative rating actions in 2022 have mostly happened in those very cyclical sectors where we see a significant margin squeeze, volume problems, and to some extent refinancing risk when it comes to the access to new financing. Nevertheless, we also have a lot of sectors where you see a strong bias towards positive rating actions. So there will be winners also in this macroeconomic environment. And these are primarily in the area of energy-related industries, also pharma. So we don't want to paint a fully black picture in that regard. That also relates to the outlooks with which we started into 2023. So on the right-hand side, you see that we have had increased number of either negative and positive rating actions. So you can ask yourself, why so many positive rating outlooks? As I said, we don't want to paint everything black. And there are definitely companies where we see a brighter future. That also has something to do with our coverage again, because on many companies, we only started coverage over the last 3-4 years. So initially, we started rather low with the ratings coverage. And as we see those companies develop rather nicely or just within expectations, it could well be that we migrate up these ratings and not down in the current environment. That should be it for a brief overview.
Thank you, Sebastian. Just maybe following up on the corporate rating picture. I mean, a lot has been riding on supply chains and energy in Europe this year, last year, and I guess going forward, that is still an issue. Now, what we have seen is pretty drastic repricing of a lot of inputs, both oil, gas, and also electricity, at least in spot markets. I mean, does that mean a big sea change here for corporates in terms of the pressure that's up on them from that side?
Yeah, that always depends on the area where you are located and whether you are a company which is able to pass on the pricing pressure, or whether you are just a company which is too small, too unimportant, and which is simply a price taker. So when we have dialed into all these conference calls of European corporates, then we hear a very mixed picture. But we want to strike that many companies are just able to pass on increased procurement costs and can absolutely deal with supply chain disruptions, while others have had problems already in the second half of 2022. But those companies, or many of those companies, are still confident that it's just a question of time until they can then be able to pass on the increased cost. So as for every credit analysis, one has to look into every little detail and to take into account the company's strengths and weaknesses. So one cannot really generalize one cannot really give a generalized question because that simply depends on company and sector. Nonetheless, and maybe we can then continue with this little poll that we have on the energy area. One of the core topics will still remain the energy pricing. So Dierk, do you want to read out?
So we can basically hear, the question is essentially what we're wondering, and I think it's also what Dennis already alluded to, sort of how much inflation, how much of this energy shock has yet to feed through the system. And I think the point also we're making here on the slide that's up is that yes, prices are down pretty drastically at this point, but at the same time, most companies they do not purchase their energy on the spot market. Indeed, the ones who did in 2022 probably are no longer with us. And the question really is there already relief from this energy price, or is it more a fact that this has yet to work through the system as companies reprice their products, their services, and essentially have locked in these prices, at least for this year and next. So the other question then is, how many supplies will there be at the end of next year, which again is an open question. So question here is, when will we truly see the impact here? Has it already happened? Will it happen in 2023, 24, or 25?
Yeah, so if I was asked that question, then I would definitely say 2025, because from my standpoint, one has to take into account the behavior of energy generators in Europe, which certainly is different from one market to the next. But overall, there is no real relief in the short term, despite the price development on the spot markets or on some futures markets. So one always has to take into account that major utilities are hedging their electricity generation volumes on not a long-term basis, but at least on a 1 to 2 year basis, which means that a lot of contracts have been settled back in H2 2022, even before, when the energy prices were already reaching different heights. And that means that when these utilities have sold forward their generation volumes, then these prices, which have been contracted at that point in time, they are then valid for the year T+1 or T+2, which means that the consumers, be it corporate consumers or retail consumers, which they have to pay in 2023 and 2024, have already been determined to a large extent in the last 2 years, where we have seen the very high prices. So the forwards, which are now logged in to some extent then for 2025, which are clearly lower than what we've seen over the last few quarters, they will only then provide the relief after 2024. So I'm afraid to say that for another 2 years, there will still be a squeeze for many companies on the energy side, because they have simply to look how they deal with the increased procurement costs and whether they can pass them on to the customers or not, considering whether these increased prices would then determine maybe a significant reduction in demand for their products and services.
Yeah, which I think chimes very well, I think, with the point Dennis was making before, that inflation in the end, particularly core inflation, could prove to be rather sticky for the next couple of years, as these effects still have to work their way through the system. So, Sebastian, we talked a lot about rating migration, things getting slightly worse, but not seriously worse yet, or maybe never. The question, though, is the actual defaults. I mean, where do we see the risk here? Where do you expect this to show up first as this works through the system?
Yes, so we definitely think that the defaults are increasing across Europe. So here I've painted with the data from Eurostat and Macrobond the actual default rates across the EU and then also across different markets. And we can clearly see that defaults are picking up, particularly from the very lows that we just had after the outbreak of COVID, and when all these resolution schemes kicked in and basically almost nobody went bankrupt. So we think that the curves on corporate defaults could trend higher than what we have seen already in the last 2 quarters of 2022. Nevertheless, we don't think that they will outpace significantly the numbers that we had before the outbreak of COVID-19. So that would be a very gloomy picture, which we think is not justified for the time being, particularly when seen in conjunction with what Dennis has shared, that Scope thinks that there is no real downturn over the next few years. So we think that default rates could return to a new normal. But one also has to make the statement that when you see the increasing numbers of defaults, then those defaults, they primarily don't relate to large caps in the corporates area. They primarily relate to micro caps. So really, really small companies, which have either been zombies for a few years, or which are just too small without a critical mass in order to survive in a normal system. So when you see, for example, here the increased default rates in France or in the UK, That certainly has something to do with the cooling off macroeconomic environment, but I just repeat that most of those numbers relate to companies which are absolutely not active in the bond market or which would make any difference in the overall picture in the economy.
And just as one point, that in terms of the downturn, we do expect a downturn, and there already has been a downturn in terms of the pace to real economic growth, especially since the second half of last year. It's only that in terms of there being annual recession, for the growth numbers to turn negative for a calendar year, true that whether 2022, 23, that we do not have that currently in terms of our outlook.
Yeah, no, fair point, Dennis. I think that's right. I think, Sebastian, so what do we know about sort of the financial health of the corporate sector? I mean, we know profits were pretty good recently, but that is only a small part, I guess, some listed companies. But I mean, what's our overall view here in terms of how well prepared are corporates entering this sort of phase of slower growth?
It's overall a mixed picture. So as I already said, you cannot generalize. So there are many companies which are pretty well set for this sobering outlook. But there are others who definitely struggle. Maybe I touch quickly on the topic of refinancing, because this is one topic that primarily relates to the concerns that we see for high yield issuers. So when you quickly look at the charts that I've painted on this slide, then you see that overall there is quite a record concerning refinancing volumes in the European area. So for 2023, there are almost 500 billion euros set up for refinancing, which is slightly more than we had in any of the historical years. And when you look at the overall interest rate environment, then you can clearly see that it will become pretty difficult for companies which will face refinancing in 2023 to log in the pretty favorable average interest rates that they have logged in for their maturing debt. So when you see that the average weighted coupon for investment grade companies was 1.7 and 3.2 for high yield issuers and investment grade issuers respectively, then you can imagine that there will certainly be problems for the high yield spectrum. So we are overall not really concerned about the refinancing activities of investment grade names. So financing is definitely available still at pretty good rates. And even if the new rates which will be locked in are slightly higher than the historical ones, then it will not much affect the creditworthiness of these companies. On the contrary, for the high yield issuers, we are a little bit worried that when you see, for example, an increase of the average coupon from 3.2 to maybe 5%, that will make a real difference then on the balance sheet already, because such a big jump could definitely affect then the debt protection metrics and overall the cash buffer of the companies which are affected in such or with such development. And this primarily affects those companies, which I pointed out are in the high yield area. But we are also a little bit wary about the companies which are not rated, which is quite a significant part of the overall outstanding debt volume of European issuers. So one has to watch out this very carefully, whether those companies which have no public rating or which have an explicit high yield rating could manage the delicate mix of the macro environment in 2023. Last point on cyclical sectors, that's, I think, quite positive, that there is not so much debt which will mature over the next 3 years, which has been placed by companies from cyclical sectors. So when one then draws the conclusion that more than 70% or maybe more than 60% of the debt outstanding has been placed by rather robust players in the market, one can really tone down maybe the voices that talk about a doomsday or a big wave of corporate defaults in the euro area.
Okay, right. Thank you. We are coming up to the 45-minute mark here. So first of all, thank you very much to Dennis and Sebastian for sharing your thoughts today. And with that, I would like to bring this call to an end. As we said before, recording will be available, slides are available here for download, and so is our sovereign outlook. And as always, we're always there to respond to questions if you have any. So thank you very much, everybody, and speak to you all soon.